Now we're going to start venturing into talking about some of the specialties about investments in equity securities. We've talked about debt, which has its own little quirks because there's premiums or discounts potentially to amortize. With equity securities as well, there's going to be an intent that's attached to it, but there's some specialty that comes into the accounting for equity securities because they do represent an ownership interest in another organization. That interest can be in the form of common or preferred or other types of capital stock. Remember, there are multiple types of stock out there. Not all of it is going to be voting. So the nature of the actual investment really is important to understand. When we are dealing with an equity issue, our first portion of understanding is when we purchase equity or stocks in another company, how much is the representation for us? Is it what we actually paid for the security? Is it par value? There's all these things running through your head because there is par value stock. And you're used to thinking about it from the organization's point. From our point as an investor, we represent the cost of our investment at what we pay for the security. What the par value is has no matter to us. It's what we paid for it, plus any brokerage fees or commissions that might be related to that purchase. Remember, par value is just a measurement value that is used from the issuing company's side. From the investor's side, the par value does not represent value for the investor. What represents value for the investor is how much we paid for something. With investments in equity securities, there is a little bit of a complexity. That complexity comes in the degree of which one corporation as the investor acquires the interest of another corporation, the investee. This is going to define the accounting treatment for how we deal with the investment subsequent to acquisition. There are 3 levels of ownership, and those 3 levels of ownership result in different types of accounting. If an investor has less than 20% of the voting stock in the other corporation, then we use what's called the fair value method. You've already seen that demonstrated with bonds. It's deemed that the investor has a passive interest. There's not a whole lot they can do to influence the other corporation. Now, if the holdings are between 20% and 50%, we use what's called the equity method, which we'll talk about here later. The investor is deemed to have significant influence over the other corporation. And if the investor has 50% to 100% of the voting stock, they have what's called a controlling interest. And the investment is then valued on the parent's books using the cost method or the equity method. And the investment is eliminated in the consolidating of the financial statements. Now that's a lot to take in, and there will be a video that deals solely with these different ownerships, but more that will focus just specifically on consolidation and how we handle that. So here's a nice little chart that shows you how we deal with the accounting and the reporting for equity securities depending on the category that they fall in. Whether the holding is less than 20%, if it's 20 to 50, or if it's more than 50. Now you'll notice that when we're using fair value, we recognize the unrealized holding gain or loss in the net income account. There are some other situations that you have to deal with when it comes to stock that are not there with debt instruments, such as when there are dividends. And when there's significant ownership, how do we deal with net income? We'll talk about those as we move through each of these different types and categories of ownership.